Today we are diving deep into a story that's been making some serious waves. We're talking about a bombshell report that puts the Walt Disney Company, specifically its world-famous theme parks, right under the microscope. Now, this isn't about the price of a churro or how long the lines are for Space Mountain. No, this goes much deeper. This is about the fundamental numbers the company reports to the federal government, to its investors, and to the world, and whether those numbers are painting a true picture of what's really going on.
Okay, let's get right into it. This report has been called a haymaker, and for good reason. That's a boxing term for a powerful knockout punch that you just don't see coming. And it's reportedly sent some major shockwaves through the executive suites at the House of Mouse. At the very center of all this is a huge question of trust and transparency, and it's focused squarely on what has always been Disney's most profitable, most reliable division.
So, a major business publication recently dropped this incredibly detailed exposé, and it casts some serious doubt on key claims Disney has been making for a while now. This is a really big deal because it digs into the data coming from the parks. And you have to understand, the parks are the financial engine that powers the entire company. So when a report like this comes out, you better believe it makes everyone, from Wall Street analysts to Disney fans on Main Street, stop and take a much, much closer look.
So what is all this fuss really about? Well, it all comes down to one very specific and unbelievably important corporate document. And look, this isn't just some glossy press release or an internal memo that got leaked. Oh no, we are talking about an official, legally binding filing that carries some very serious weight and even more serious consequences if it's found to be misleading.
The document in question is the company's 10K filing. Every year, public companies have to submit one of these to the Securities and Exchange Commission, the SEC. You can think of it as the company's official end-of-year report card that it gives to the government and to all of its investors. It's meant to be the single source of truth about the financial health of the business.
And here is the absolute crucial point. The thing you have to remember through all of this, these are sworn documents. The information inside isn't just a suggestion or a friendly update, it is legally required to be accurate. I mean, the entire system of public investing, the whole stock market really, is built on the idea that these filings are trustworthy. Lying or even just misrepresenting information here isn't just bad PR. It can lead to massive fines and serious legal trouble.
And that question brings us right to the heart of this entire investigation. What the report uncovered was a glaring discrepancy. It's a disconnect between a statement Disney made in its filing, a description of its business trends, and what the actual hard financial data from the last couple of years shows. It's the classic case of a company saying one thing while its own numbers are screaming something completely different.
To really get to the bottom of this, we need to look at what we're calling a tale of two summers. This is where it gets really clear. We're going to put what Disney said right next to what the numbers showed. This is a direct comparison between the company's narrative and its recorded financial performance.
Okay, check this out. On the left, you've got the official statement from Disney's annual report. It says that revenue in its experiences division, that's the parks, cruises, all that stuff, generally increases during the summer quarter. Pretty straightforward, right? But then, look at the right. The analysis of their own data shows the complete opposite has been happening. For the last 2 years straight, that exact same summer quarter has actually been the lowest revenue period of the entire year. This isn't just a small gap, it's a direct and total contradiction.
Let's put some hard numbers to this. From their third quarter to their fourth quarter, that's the period that covers that critical summer season. Revenue for the domestic parks didn't go up, it went down. It crashed by 8.5%. Now, for a division that's supposed to be the company's rock-solid foundation, a swing of that size in the wrong direction is a massive red flag.
Now, if revenue is all the money coming in the door, operating income is the profit. It's what's left after you pay all the bills to keep the lights on and the rides running. And this is where the story gets even more shocking. That number didn't just dip, it collapsed by an incredible 44.2% in that same time frame. That suggests that not only was less money coming in, but their costs were eating up way more of it, sending their profitability into an absolute freefall.
And this, right here, shows you the real-world impact. Fewer dollars usually means fewer people walking through the turnstiles. The report estimates that about 783,000 fewer people visited the domestic parks compared to the year before. I mean, to put that into perspective for you, that's like the entire population of Seattle just deciding, nah, not going to Disney this year. That is a huge drop in foot traffic. Okay, so you might be thinking, all right, I get it, but it's just one sentence in a huge, boring legal document, right?
Why is this one statement about summer business such a massive deal? Well, that is a fantastic question, because to understand the answer, you have to understand why Disney would risk its reputation by painting a rosy picture that the data just doesn't back up. To get why this matters so much, you have to grasp just how critical the theme parks are to Disney's entire financial world. They aren't just one piece of the puzzle. In so many ways, they are the puzzle. They are the profit engine that keeps the whole Magic Kingdom, from movies to streaming, up and running.
Just take a look at this chart. It visualizes the profit breakdown for the company, and the story it tells is just, wow. Look at that enormous slice for parks and experiences. It brought in more profit than their entire entertainment division and their sports division, ESPN and all, put together. It doesn't just edge them out, it absolutely dwarfs everything else. This chart makes it crystal clear where the real money is being made.
And that really gets to the core of it. For the last few years, the money made from theme parks, cruise ships, and selling merchandise has essentially been propping up the rest of the company. It's been subsidizing the billions and billions spent on Disney Plus and covering for movies that maybe didn't do so well at the box office. The parks have been the company's financial safety net, plain and simple.
Because of all that, maintaining the perception that the parks are an unshakable fortress of profit is absolutely critical for investor confidence. Shareholders have come to see the parks as the one consistent, reliable performer in the whole portfolio. So any hint of weakness, like, say, declining summer revenues, could seriously spook those investors and send the stock price into a nosedive. And a big drop in the stock price isn't just a number on a screen, it affects the company's ability to borrow money, to fund new projects, and it can even impact the jobs of thousands of cast members.
So this all leads us to the final critical question. What happens now? What are the potential consequences for Disney? Are we looking at a simple clerical error that gets a quick correction, or is this something much, much more serious? The kind of thing that could trigger a full-blown investigation from the government.
And this is where we step into a really fascinating gray area. See, according to legal and financial experts, Disney didn't necessarily report the final dollar amounts for revenue or profit incorrectly. The raw numbers on their balance sheets, those seem to be accurate. The problem is with the narrative flair, the written explanation, the story they told to go along with those numbers.
The problem is really in that one descriptive footnote we talked about, the one about seasonal trends. The argument is that this statement might have been true 10 years ago, but it just doesn't reflect the new reality of a post-pandemic world where people's travel habits and spending patterns have been completely turned upside down. It's basically an old story that hasn't been updated to fit the new data.
And this is where it gets legally complicated. Look, making any incorrect statement in a federal filing is a serious problem, and it absolutely has to be corrected. But this kind of interpretive error might not be seen in the same light as, say, deliberately faking the numbers. It's very likely that Disney's lawyers will make sure this kind of language never appears in a filing again, but it might just fall short of what's needed to trigger a full restatement of their financials or a major penalty from the SEC.
And all of this leaves us with one final provocative thought to chew on. In an age where giant corporations craft these powerful, compelling narratives around their data, what happens when that narrative starts to drift away from what the numbers actually show? Where does the ultimate responsibility lie to make sure that the story being told to investors, and to all of us, is the story the data is actually telling?